Welcome to all the students of MCOM Part 2. I, Pooja Singh, will be your teacher for the subject Business Finance. Today I will start my session with the introduction to syllabus and objectives of business finance. So before turning to introduction to syllabus and objectives of business finance, first let us see the objectives of the course. We will see the objectives of the course one by one. Let us see the first one. To acquaint the students with corporate finance required for Indian industries. So why all Indian industries required corporate finance? So this is your foremost objective of your course. The second one comes to make the students aware about the latest developments in the field of corporate finance. What are the latest developments which are there in the corporate finance? We will be discussed in this course. Third one is to enable the students to understand the traditional theories of capitalization and dividend distribution practices. So what are the theories related to capitalization and the dividend distribution practices followed by the company or the organization will be seen in this course. Fourth one and the last one is to give detailed exposure of working capital management practice of finance to students' skills to be developed. So last one is your working capital management practices which are adopted by the various companies is your fourth objective of the course. Now let us see the syllabus. In syllabus, your first chapter comes business finance. In business finance, we will see its meaning, objectives, scope and importance. Meaning, why the objectives of the business finance, scope and why we need business finance, that is its importance. Next point is time value of money. In time value of money, we will see its need, importance, future value, present value through discounted cash flow technique. So this one is your first chapter, that is business finance, and it comprises of the 2 points, that is one is concerned with your business finance and another is with time value of money. Next one is your chapter 2. The chapter 2 is strategic financial planning, in which we will see meaning, objectives and assumptions of strategic financial planning. Next point is steps in financial planning. What are the steps are required to be followed for developing financial planning? Third one is estimating financial requirements of firm, limitations of financial planning. Fourth, capitalization, in which we will see overcapitalization and undercapitalization. At what circumstances or in what circumstances overcapitalization occurs and undercapitalization occurs and how we can reduce it. So this is your fourth point. Fifth one is theories of capitalization. And the last point is estimating financial needs and sources of finance. Now let us see your third chapter. Your third chapter is corporate securities and sources of long-term finance. In this, first point comes ownership securities. Your ownership securities consist of equity shares and preference shares, in which we will see in equity shares its characteristics, advantage and disadvantages. Your preference shares will consist of the same thing, that is characteristics, advantage and disadvantages. After that comes your Companies Act Amendment 2013. We will see what are the changes made in the Companies Act 2013. The second point here is creditor securities. In creditor securities, we will see debentures, in which in debentures we will see characteristics, classification and the procedures for issuing debentures and bonds. Third point comes company deposit. Fourth, the dividend decisions. In the dividend decisions, we will see background of dividend policy, theories of dividend, trend in dividend distribution in India, measures of dividend policy, dividend yield and dividend payout. This all thing we will see in the dividend decisions. And your last chapter is short-term finance and working capital management. In this, we will see first characteristics of short-term finance and short-term needs. Means characteristics, what are the characteristics of short-term finance are and why we need short-term finance. Fourth is sources of short-term finance. What are the various sources of short-term finance available for an industry? Role of working capital, best management practices of working capital. And your third point is financing of working capital, trade creditors, bank credit, bank financing of account receivables. Means in financing of working capital, we will see trade creditors, bank credit, and bank financing of account receivables. Next, we will see working capital. In working capital, we will see its meaning, advantage and disadvantages. So your syllabus basically consists of 4 chapters which will be covered in your subject business finance. So this whole was your syllabus. Now let us see the chapter 1 business finance. In this chapter 1, first we will see the meaning of business finance. See, money required for carrying out business activities is called business finance. It's a very simple meaning which can be given to you. Means money required, whatever the activities, operational activities which is conducted by a company requires money. And the money which is required to carry out this business activity is called business finance. It means the funds and credit employed in the business. Finance is the foundation of a business. Why it is the foundation of a business? If money is not there, if finance is not there, how can a business can establish? A business establishes with the capital, with the finance. That is why your finance is the foundation of a business. Availability of efficient finance is very crucial for the survival and a growth of a business. Yes, for a business to survive and to grow, to expand, to diversify its business activity, one needs finance, and that finance should be used efficiently. That is why finance is called the lifeblood of the business. Why it is the lifeblood of the business? If there is no finance, there will be no business activities, there will be no diversification, there will be no purchase of raw materials, goods, etc. So that is why your finance is called the lifeblood of the business. Finance is required to establish a business, run a business, to expand and diversify the activities of business, to purchase assets, goods, raw materials, and for the flow of economic activities. As I mentioned, finance is required at every stage of business, whether it is the establishment of business, run a business, to expand and diversify the activities of business, to purchase assets, goods, raw materials, and the other flow of economic activities which is carried out in a business. So these all activities require finance. That is why a finance is called lifeblood of the business. So this was your meaning of business finance. Now let us see the objectives of business finance. The first objective is revenue generation. See, increasing income is the most basic and fundamental goal that is of financial of business. And revenue growth comes from an emphasis on sales and marketing activities. And for generating sales or marketing activity, one needs finance. And through finance only we can generate revenue. And from revenue we can generate profit. So for revenue generation, one needs finance. So the foremost objective of business finance is revenue generation. And that revenue generation comes from an emphasis given on sales and marketing activities. For example, the objective of a business for a company is to increase revenue by 15%. So to increase the revenue of the business by 15%, one needs a heavy expenditure or heavy investment in the sales and marketing activities of a company so that we can generate the revenue, and that generation of revenue will ultimately give you the profit. So to generating this revenue, one needs a finance to invest in that particular activity. So the foremost objective of your business finance is revenue generation. Next comes your profit maximization. See, profit is a key objective of business finance, which are more sophisticated than your revenue generation. Any money left over from sales revenue after all expenses have been paid is recognized as profit. So, profit objectives are concerned very first with revenue, then with costs. And maintaining expenses low by finding and building relationships with dependable suppliers and creating more profit is a key objective of a company. So profit maximization is what? Firstly, what is profit? See, whatever the expenses which are paid after you have generated the revenue and paid all the expenses. So the leftover money is your profit, and that profit is needed to expand and diversify your business in the longer period of time. So basically, the very first of the objective of a company is to earn profit. So this is your second objective of business finance, that is profit maximization. Next comes your managing operational activities. See, for operation of activity, for operation of people, to operation of work, all these activities require finance. To manage these operation of activities, one needs to have a finance. If the finance is there in the company, these activities can be managed very properly. So your third objective of business finance is managing operational activities. Third, come maintenance of liquidity. See, in a company, there is a need to maintain the liquidity because one needs finance to carry out day-to-day expenses or day-to-day activities of a company. So there should be an ample amount of liquidity in the business. So your fourth objective of the business finance is maintenance of liquidity. The fifth point is sustainability, and here sustainability is concerned with the survival of a company. See, there are some situations when companies have to face economic turmoil, or when they are not earning enough profit or revenue, or when there is a declining stage of the product or the life cycle of the product or a brand. So in those situations, the sustainability of a company comes to a halt. And to survive in those periods, to sustain in those periods, a company needs a finance so that it can boost its activities to overcome that crisis. So that sustainability is the fifth objective of business finance. The next comes your contingency plans for unexpected occasions. See, unexpected occasions are concerned with the natural disaster, employee strike, or halt manufacturing during the economic crisis. So these are the unexpected occasions which a company has to face. So in order to meet with these unexpected occasions, company plans contingency plans or economic or emergency plans. And to boost these emergency plans or the contingency plans, a company needs finance. So finance is the basic aim or the basic objective for the contingency plans to meet those unexpected occasions so that company can get out from those unexpected occasions and survive for a longer period of time. So that is why your sixth objective is contingency plans for unexpected occasion. The last one is your employee benefits. Employee benefits here basically is concerned with the employees. Performance and production are very important, but at the same time, employees' health is also a major objective of a business finance. Fair compensation and benefits are objectives of every continuing business should make an effort in this area. Happy employees and healthy employees are more productive and bring more efficiency and more gains to the business. So the finance is needed for the employee benefits also to boost their morale, to motivate them to work. So these were your objectives of the business finance. First one was revenue generation. Second, profit maximization. Third, managing operational activities. Fourth, maintenance of liquidity. Fifth, sustainability. Sixth, contingency plans for unexpected occasions. And seventh, employee benefits. If you have any problem in these objectives of business finance, you can comment in the comment section so that I can get to know what are the problems you have faced in this objectives of business finance. Thank you.